We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lobo Tiggre, author and publisher of The Independent Speculator. How are you today, Lobo?
Just fine, Tom. Looking forward to 2023.
Absolutely. Of course, you're my first interview of the new year here, and looking forward to kind of digging into some of the ideas, some of the things to look forward to look out for, and see how you're looking at the world here. But I kind of wanted to start by reviewing a little bit, if you would, one of the pieces that you wrote at the end of the year last year, and get your thoughts about how to think about trying not to be persuaded by, let's say, imminent and broad theories that fit our worldview, yet can't necessarily be proven wrong until after they're no longer relevant. So what made you write this piece and really kind of get into that mindset?
Wow, I'm glad to have a chance to talk about this, because I thought this was something. It's something I've been thinking about for a long time, Tom. I think it's actually quite important, but it's not the sort of thing. It's not a stock tip, or it's not a here's this helpful hint that will take care of things for you. So I just figured not many people would read it, but I wanted to write it, get it on the record, get it off my chest, if nothing else. It has the very snazzy title of Rationalism versus Empiricism in Securities Analysis. And I did that on purpose because it's kind of a philosophical take. But the point is, if you remember your college, high school and science classes, empiricism, that's the root basis of science. We test, we look for empirical facts, measurable facts, knowledge based on the real world. Rationality is fine. There's nothing wrong with reason. I'm certainly a fan of logic. I don't want to be illogical. Mm-hmm. But the problem with logic, theory, is that theories are only as good as the inputs, and you can have a perfectly logical train of thought, and if any of your premises are wrong, the conclusion will be wrong, mm-hmm. or will only be right by accident. And the reason this is important for investors, this isn't a purely philosophical, discussion. This is important because there's a lot of people out there that will sell you some big macro theory, and it logically has certain investment conclusions, which may or may not be right, or they may or may not be right within the time frame that you want. But they're particularly attractive, these theories, if they fit with our worldview. If I'm, the typical gold enthusiast, as I am, they're skeptical of big government, they like free markets, and that makes us susceptible to theories like central banks have this evil plan to suppress gold, or to buy gold while it's cheap and then make it go up, or whatever the plan is. The problem with this, it might even be true. But the problem is, you have a theory like this, there's no way to test it. There's no empirical measurement here, unless you could kidnap a bunch of central bankers and give them a truth drug and get the truth out of them. I mean, it's not testable. Mm-hmm. But it makes for great ad copy, and you get people all excited and they rush out and they make investment based on some promise, based on this theory that makes so much sense to them. And then years go by and nothing happens. And I think this leads to unhappy outcomes for a lot of investors. They get disgusted. Things don't seem to be going the way they should. Nothing makes sense. And then they give up, they go home, and then suddenly gold breaks out or something. And then they rush back in again, and they end up, buying high, selling low, all these things. So the public service of that article, I think, is just to deliver a wake-up call and get people to think about this. If there is a takeaway that we sneak preview for the audience, is when somebody has this big, wide, explanatory theory, right? You need to be doubly suspicious of it if it's one that you like, fits with your worldview, and ask yourself, is this provable? How do we know? And if it comes with therefore buy my newsletter right now to find out my secret stock tips for playing this trend, be especially cautious about that kind of sales pitch.
So you mentioned actually one example I'd like to kind of go over, if you wouldn't mind, as part of that. How do we apply this thinking to, let's say, how much gold central banks have been buying and what that ultimately means for the gold price?
Yeah, well, so I don't know if we're going to get hate mail for this, Tom, or not, or what the comments will be like. So let me first say that I don't know what the central banks are doing, and I don't think anybody outside of them does. Mm-hmm. Well, the problem is you get these guys on Twitter or LinkedIn or whatever saying, oh, the central banks are doing this for this reason, and this will happen. They might be right, but your thesis, your theory is not a fact. It's a theory. Your opinion, is not a fact. It's an opinion. Mm-hmm. And if you persuade people to invest based on this opinion and you're wrong, you can hurt a lot of people. So with the central bank thing, I mean, it is interesting that through the IMF reporting that we all see through the World Gold Council, central banks have been accumulating a lot of gold. Net, they've been buying for many years. There used to be a central bank agreement not to sell more than 500 tons a year, a ridiculous number. But now you don't even need the agreement because they're all now on net, they're buying. But this lends itself to theories. This is exactly why it's so powerful. Why is it happening? And if somebody presents you with a credible case, one of the theories was that the central banks were suppressing the price of gold, keeping the price of gold down so they could accumulate it before remonetizing, before putting their currencies back on a gold standard and having accumulated a lot of gold on the cheap. And some people put that together with the Basel III Accords and how the Basel III rules have gold as a reserve asset now, a tier 1 reserve asset. People saw this as an admission, as proof, the smoking gun that the central banks, they really had this plan to suppress the price of gold while they could buy it. And then, the theory was that after Basel III came into effect, the gold price would go high because the banks already had all their gold. Well, that didn't happen. Mm-hmm. And as an example of what I'm talking about, like this Basel III thing was years in the making. And then it rolled out and it was only partially implemented. And then, oh no, well, it's not going to happen until it's fully implemented. And then, it gets fully implemented, still nothing happens, right? So whatever else we might say about central banks and their gold buying, it's pretty clear that they were not going to unleash the dogs of higher gold prices after the Basel III went into effect, because that didn't happen. Now, so I'm not sure where to go from there, Tom. I don't want to gore any more sacred cows than I already have, but just please, dear audience, when you are peddled a theory that you want to believe because it fits with your worldview, that's really the time you need to be more cautious. Because if anybody bet on that, on the basis of gold going through the roof when Basel III went into implementation, then they got hurt. And I would hate to see more good-hearted people, right-thinking people get hurt on that kind of basis.
Mm-hmm. Well, I think that's a very prescient example, because that's within my memory of doing this show, hearing theories from one side or the other and really seeing it have, no material effect on the actual gold price. So, is another example of this maybe the thinking around, let's say, supply side deficits that may be looming in some of the metals that we pay so much attention to?
It could be. That's certainly the kind of thing that lends itself to a scare. And supply does matter. I mean, prices that are determined by supply and demand in general. It matters more for regular commodities that are consumed regularly. Mm-hmm. It matters much less for something like gold, which is, it does have industrial uses, and I would include jewelry and dentistry and all that as a quasi-industrial use. Well, the dentistry is industrial, but the jewelry you could think of as a kind of industry. Mm-hmm. It's separate from the psychology of investing. But as many people have pointed out, the amount of purified gold on the surface of the earth, most of the gold ever mined, I don't remember what the numbers are. Nobody really knows, but the numbers I've seen are calculations like 95 to 97% of the gold ever mined is still on the surface of the earth in purified form in vaults or rings or whatever. It's there, it's accessible. So the laws of supply and demand really don't work so well with gold. The amount of gold on existing is so much more than mine supply that you could stop mining and it really doesn't impact the price of gold much at all. If it's there, right? That doesn't make the supply go away. And silver is somewhere in between. It is industrial and monetary. Mm-hmm. So I'm very cautious about, and I warn people to be careful of people trying to make scares, especially in gold, also in silver, about supply threats to it, because the prices tend to create supply very easily there. Whereas price movements, say in copper or nickel, that's not going to create supply. But there's if the price of copper goes up, it's going to be years before the big mines come online to start producing that. It's not like grandma has copperware instead of silverware that you can take down to the pawn shop. You know what I mean? People don't, LBMA has copper, but most people don't store, tons of copper in their bank vaults, and it's too bulky to fit in your bank deposit box. Mm-hmm. So it doesn't have that kind of supply that can come onto the market the way monetary metal supply can. So I do think that is something to be cautious about. Beware of, exciting theories about why supply squeeze, has to move the price. If it comes with a deadline, right? If it tells you when the supply squeeze is going to create a price movement, be very cautious.
Well, and I think another example, as you're talking about copper, is the idea that the cost of the metal was below the cost of production for quite a while, and sometimes those kinds of situations take time to resolve, right?
Yeah. Well, that points in a whole different direction. I've said in a couple interviews recently that I'm no fan of the efficient market hypothesis. I think any speculator, especially in the commodities space, knows how. That used to be true, but maybe now not so much. After the advent of the cryptocurrencies and the meme stocks, who can believe in an efficient market when something like a cartoon on a Reddit channel can send a completely bankrupt company's shares up hundreds of %. That's just crazy. Mm-hmm. So yeah, I'm not a fan of the efficient market hypothesis. This is a good thing. It creates, when markets overreact, they can get overbought and oversold. And when there's a difference between price and value, you can go long or short. The odds are that price will come back to value. And if copper's selling, I remember what you're talking about. It was like 70 cents when the cost of mining was $1 or 90 cents or something. And, for years that persisted. That shows you how markets can overshoot. Mm-hmm. But, let's take this from theory, macro theory, to practical reality right now. A lot of people are thinking, oh, well, this recession of 2023 is the most well-signaled recession ever. Everybody knows it's coming, therefore it's priced in. Mm-hmm. Well, that may or may not be true in stocks. I think it isn't, but I'm damn sure that it's not in commodities. That even when people see these things coming, commodities traders they don't seem to read the same newspapers as the equities traders, and they always seem shocked when the actual recession shows up. Mm-hmm. And copper and the industrial minerals, they all take it on the chin when the reality hits the fan. And I think that's ahead still in 2023. So, and you could say, oh, well, costs are up, and if the average cost of production should be a floor under the price of copper. Well, in a perfectly efficient world, it would be. Mm-hmm. But we don't have a perfectly efficient world or perfectly efficient markets, and it never is. The prices always go way lower. Uranium dropped to $18 a pound 5 years ago. That even Kazatomprom couldn't supply enough uranium at that price. So it is naively optimistic to adhere to this macro theory, or the theory that the The cost of production is a floor, and experience has told us that at times like this, when the reality of the recession hits, it is likely to be bad for industrial metals. And I include the platinum group metals in that category.
Mm-hmm. Well, on that point, the IMF recently predicted that a third of the world's economies will be experiencing recession this upcoming year. So, do you think that
she's an optimist?
She's an optimist. Okay. Do you think that there are more, let's say, negatives in the forms of, let's say, recession as one example for at least, let's say, a third of the world than positives in the form of maybe China reopening? I know you're thinking a lot about that. We're seeing that evolve as we speak here. So, are there more positives in your mind than negatives, or vice versa?
I think there are more negatives, but they're not of equal magnitude. The honest answer, Tom, and dear audience, is I really don't know. Mm-hmm. I see countervailing forces here. The China reopening thing, that is big. I mean, that is huge. And you can say, oh, well, but if the world's in recession when China reopens, that will blunt the impact. You could put it the other way around. Mm-hmm. The world's in recession, but all those Chinese that have had years of pent-up demand, we hunkered down for a year and a bit, for COVID. They've been hunkering down for 2-3, going on 3 years now from the beginning. And so I see a huge wave there. That's really big. But on the other hand, the global recession here is a big thing, and it's not just any one economy. What's happening in Europe, what's happening, I think, in the US is much weaker than people realize. I think the UK is a real bellwether where you see very high inflation, and they are the poster child for the modern version of stagflation now. And we can look to the UK to think about what we're in for in other places for stagflation. So I think this is big. And then there's one more thing, and I'm not predicting doom and gloom here. I'm not saying the world's about to blow up, Tom. But if there's anything we learned from the COVID lockdowns, it's that the global economy is anything but anti-fragile, to use Nassim Taleb's term. Right? There's a great deal of fragility out there, interdependent systems that we didn't realize, how fragile they were until the lockdowns came and started breaking things. So the lockdowns are not entirely done yet, but even if they were, now we have a war, a major war in Central Eastern Europe. And even the shooting match aside, we have the new Iron Curtain going up, which includes China on the other side from the West, as well as Russia. So these are not small factors. These are major changes in not just geopolitics, but the global economy. At the very least, these are inefficiencies, significantly increased inefficiencies that have an economic cost, at the very least. And then you put that together with what we learned about how anti-fragile the world economy is. And there is the potential for things to really go off the rails. Something breaks the way it did in the UK, and they had to do their, insta pivot there. Something big breaks in the major economies, and things could spin out of control. I'm not predicting the end of the world. I'm just saying, that card is somewhere in the deck. I don't know when it turns up. Maybe the powers that be can paper this whole unpleasantness over. A bunch of easy money comes next year in response to the recession. That would be my expectation. And nothing bad happens. But you asked me early in this interview about potential black swans. I think the maybe gray swan, I'm not entirely black, because what I'm saying is we are aware now how fragile things are. I can't tell you which system will break, which critical thing will cause the next Lehman moment. But the potential is for that to happen this year. And there's enough rattling of the cages out there that, who knows when the beast is loosed. So at the very least, dear audience, I think all the gold bugs and silver bugs out there we have, I think it's a very important time to make sure you have insurance in the form of physical bullion in your direct personal control. Paper gold and silver is not the same thing. And depending on how it plays out, our speculations on related stocks could make us a lot of money, even when everything else is going to heck in a handbasket. But even if not, I do think that the fear and uncertainty out there, the persistent high inflation, the stagflationary environment is very supportive for gold and silver. And if the powers that be respond to the recession with easy money, then I think that will be very, very good for monetary metals.
Yeah, absolutely. And I'd like to ask you a little bit about let's say the drivers for the gold price as we've seen them a little bit later. But I think what you were referring to as let's say the opposite of a black swan is a big gray rhino, something that we should have seen that isn't necessarily, as quick and as unexpected, but should cause just as much, if not more, destruction. And I think it's only a matter of time before we see that really work its way through the economy. But, in that vein, Lobo, I heard you recently say that you think that the EU central bank could be being seen as being more hawkish within the currencies that make up the basket of the DXY index. So why is that?
Yeah, I think this is quite important for commodities investors in general and for gold and silver bugs in particular. I have a thesis that I think has actually been borne out pretty well over the last couple of months, that the Fed led the way in tightening, and the Fed is and will lead the way in easing. And, that affects the dollar wrecking ball, if you want to call it that, or the dollar milkshake mechanism, if you want to call it that. And we've seen that actually play out. Earlier in 2022, the dollar was zooming higher as the Fed was leading the charge tightening. And that hurt. We got gold all the way down to mid 1600s. But then, that came to the point where, the Fed started thinking that maybe enough's enough. Maybe we'll pause and evaluate, long and variable lags. We've done a lot already. And so without wanting to give the markets too much excitement, let them loose again, irrational exuberance, they have signaled that they are going to come to a pause. They're approaching their terminal rate. And probably the next meeting or two, we will see the Fed pause to evaluate the results. At the same time, we have the ECB saying that they're going to keep steady. They're going to keep steadily on the increases, which are at 50 basis points. So the interest rate in Europe is still much lower than the US. So you can't just say, oh, well, interest rates are lower in Europe, so it's less hawkish. Mm-hmm. Markets are forward-looking. So if you have the Fed, talking about stopping and the ECB talking about continuing at a very high pace, 50 basis points per meeting, that's what makes the ECB relatively more hawkish than the Fed. And that affects the DXY, which, how the dollar compares to other fiat currencies is really quite irrelevant to the real world value of gold. But it is how most traders recently have been, it's been the main driver over the last year for the price of gold. I like to compare it to a Rorschach blot. You look at the gold price chart and the DXY, mm-hmm. and it's just amazing how closely it corresponds on a day-to-day basis. Mm-hmm. So that's been a headwind for most of 2022, but with the dollar having rolled over and this scenario where, at least for the first half of 2023, it seems likely that the Fed will appear more dovish compared to the ECB, that's bearish dollar, bullish gold and silver.
So, Lobo, you've spoken before about the fact that real rates really tend to have driven the gold price in the past, and that it has recently been, as you say, this inverse of the DXY. So why do you think that change has occurred? And do you think that it necessarily matters to gold investors?
It matters because if it changes, then, my thesis that the DXY or the dollar falling compared to other currencies will be good for gold in early 2022, 23. Mm-hmm. If that relationship changes, then that could be bad for gold. It doesn't have to be. We have seen times when gold and the dollar go up at the same time. It usually it's short-lived, like when Russia invaded Ukraine. That fear that drove people's sphincters clenched, right? And people panicked into what? Well, people bought dollars and gold. Mm-hmm. And oddly enough, that happened back in 2014 as well, when Russia took Crimea. But it's not just wars, it's other things too. There are times when the flight to safety, the safe haven demand, will drive both gold and the dollar. And that could happen. The thing is that over the bigger picture, the last 50 years, since the dollar was severed from gold by Tricky Dick Nixon in 1971, over time, the most explanatory variable, no variable explains or completely, predicts or explains the price of gold, or the gold dollar exchange ratio, as I like to call it. But the most powerful one has been real interest rates. Mm-hmm. If you chart all the major, the DXY or the previous dollar exchange, the most explanatory variable has always been real interest rates. So that's interesting that in recent times, it's been more directly the DXY and not interest rates. And I had a theory before. My big theory was that, once you have interest rates artificially nailed at zero, they become less useful as a signal. Like, they're not real. You don't believe them anyway, and they're nailed to the floor anyway. So maybe you start looking directly at something else, like the DXY, because the rate isn't giving you useful information. But rates are no longer nailed to the floor. They are giving you information, and yet the markets just still are. These COMEX traders, for whatever reason, I don't know any of them personally. I can't call them up and ask them. I wish I did, and I don't know if I get a straight answer. And they may all have different reasons, Tom. I don't know, mm-hmm. But so far, they're still trading more directly on the DXY, and I don't know why that is, which makes me nervous because I don't know when it will change. But for now, the relationship is still strong, and it's actually been a big help to gold and silver bugs, because the normal relationship of interest rates, that has become less negative. Right? They're still, compared to CPI anyway, real rates are still negative, but they're much less negative than they were before. And usually that directional change matters. Okay, they're still negative, but they've come up. They're much less negative before. That change of pace, that should have really whacked gold much harder than it has. The fact that gold was flat in 2022 in the face of significantly less negative real rates, I find that actually quite encouraging. I know a lot of gold bugs have been pulling their hair about gold underperforming in a period of high inflation, but giving the improving real interest rate scenario, which normally would have really clobbered gold, I found that quite encouraging. I see real strength in the demand there. So I don't know when it changes. This is a question mark to be paying close attention to in 2023. Mm-hmm. But for now, it still seems to be the DXY in the driver's seat. And that actually, I think, is very bullish and in the near term.
Mm-hmm. You call the DXY the dollar exchange rate, or the wrong trousers for gold. So yes. Why is that, Lobo? That's an interesting term to use for gold, and comparing it to gold as a benchmark, right?
There is a free article at independentspeculator.com on the wrong trousers explaining this. It's a reference to a claymation animated film that my children loved. There's these Wallace and Gromit cartoon, claymation cartoons. They're very clever, very funny. And there's an episode called The Wrong Trousers. And it's not terribly directly relevant. It's just, it's the wrong thing. It's the wrong measure. Mm-hmm. And as I mentioned just before, how the dollar compares to the euro, or to the South African rand, or to the renminbi, or the yuan, or the yen. These relative debasements of fiat currencies compared to each other, that has nothing to do with what gold, a physical thing that does have industrial uses, that has its place in the monetary firmament as well. Why should the central bank of Japan, being crazier than the central bank of the US, have anything to do with what you might pay me to give you this ounce of gold that I have and put it in your hand? It has mm-hmm. nothing to do with it. And what makes it the wrong trousers is that it's the wrong variable, but you're in it anyway. That's what the traders are basing their decision. We can see that in the data on a day-to-day basis. we shouldn't have to pay attention to the DXY so much. But we do, because that's the most explanatory variable right now. So, at some point, and, maybe the fiscal response to this next recession here will be, I don't know. The powers that be have been able to kick the can down the road far longer than I thought, Tom. But at some point, this experiment that the world has with fiat currencies, which, the average person thinks of money as being like these pieces of paper or the traces of them in their bank accounts. This is a very recent thing. It's only the last century or so that's been the way things are. And people imagine, I don't know, they just don't think about it. They don't understand what real money is. Very few people do. And the point is that this fiat money experiment really is an experiment. It's not normal. It's not written in the cosmic firmament. It's not how things should be. It's not how God meant them to be. It's not how the universe meant them to be, or any other force out there. It doesn't have to be that way, and it wasn't that way for most of history. It is an aberration. It is, I think, governments trying to squirm out of their responsibilities, divorcing commodities from their money so they could be profligate. And eventually that piper will have to be paid. And so the wrong trousers gets Wallace into a lot of trouble. And I think people that rely on the DXY as a infallible economic signal forever are, they're missing that it's just a comparison amongst fiat currencies. It's largely meaningless.
Mm-hmm. Lobo, if you had a magic wand and could fix, let's say, any of the problems that you see in the financial world right now, what would you choose to start with? Could a really important place to be focused on is letting the market decide what interest rates should be rather than central banks?
That would be a wondrous thing, and it would cause a catastrophic adjustment. I mean, liquidation of all the eras that have been built on that would be huge. You could go deeper and say ending fractional reserve banking would be an even more fundamental shift. But ultimately, the real magic wand, and this is total fantasy, you're asking me, to dream, if I could dream whatever I like. Well, I think there should be separation of economy and state for exactly the same reasons that we have separation of church and state. The economy, the money supply, all these things, they're much too important to be entrusted to governments, which are run by politicians, which we all know, are not saints. Even if your guy is a saint, all the other guys aren't saints. And, they outnumber the saints. So, just my distrust of politicians, and I think the track record of politicians around the world and across history makes me not unreasonable for reaching that conclusion. Just it's far too much power to let the governments into our wallets and our bank accounts. They can control our lives far too much that way. So that would be my wish. If I could have a magic fairy come down and grant me the separation of economy and state, I would be a happy camper.
Mm-hmm. Yeah, it's kind of funny to think about the idea of giving your magic guy or your knight in shining armor politician all the power that you wish him to have, because if and when the next person gets in that is maybe from the opposite party, you need to remember that they will also have the ability to wield that power, right?
Oh, absolutely. That's so, I can't tell you how many times I've heard that, and particularly in the US in recent history, people wanted to give a certain president, enormous powers. And I'm just thinking, once you give, it's not him, it's the office. Mm-hmm. And you give that office that power. And what happens when someone who doesn't agree with your priorities and principles has those same powers? That's a great point, Tom. I remember that Jefferson was surprised that the United States government lasted 25 years. He didn't think the chains that the founders had put on the beast would last that long. And it's astounding to me that, some remnants of them are still there, but it's pretty shaky.
I was going to say one could argue that those chains are a very weakened ghostly figure of what they once were, right?
Yeah, I don't know if it's true, but I've heard that Henry Kissinger once said that anything illegal was no problem for the administration. Anything unconstitutional would just take a little longer. I don't know, Tom. We don't want to get too philosophical here on my anarchist leanings and so on. But there is, I think, a practical aspect and in a money related aspect. But I think one of the things I got from Doug Casey, who, was my mentor and taught me most of everything. Well, Doug and Rick Rule are the two biggest teachers I've had in this space. And I'll forever be indebted to their time and effort they put into trying to pound some sense through my thick skull. But both of them have very little use for government. And I think that's right. And I think it's also good that they're neither left-wing nor right-wing. And that's important because the majority is left-wing, right-wing, Republican, Democrat, or whatever you call them, whichever country you are. And people take sides. They put blinders on. My side's right. The other side, therefore, must be wrong. And if you have an ideological bias, that makes you vulnerable in the marketplaces. And it's not just the politics, it's the economics and therefore the impact on our investments. And if you drink the Kool-Aid from one side or the other, and you're unwilling to look at data that doesn't agree with your side, you make yourself vulnerable. Mm-hmm. And so actually, a lot of people don't like Doug's extreme anarchism. He's kind of a firebrand. He'll throw intellectual, napalm into the audience from time to time. I've seen him do this live. It's sort of entertaining. But at the end of the day, the fact that he was neither left nor right made him, I think, a less biased, more independent observer and able to tell people from both sides, look, you're missing something important, and this will impact your ability to succeed in the marketplace.
Mm-hmm. Yeah, I think it's always important. What's that quote? I think it was from maybe Benjamin Franklin: "Those who seek comfort and give up their independence deserve neither." I know I butchered that, but
I know the quote you mean. Yeah, those who sacrifice freedom for comfort shall have neither. Something like that.
Yeah, absolutely. Yeah. So, Lobo, maybe we could kind of wrap up by getting your thoughts of what you're looking forward to for 2023 here. Let's say particular investment themes or things to watch for coming, let's say in the precious metal. Why don't we start with the precious metal space for now?
I'm very bullish on gold and silver for early 2023. I think the main thing there is to watch the long trousers. Keep an eye on the DXY. As long as that trend remains downward, I think that's very bullish. We need to watch for changes that might derail that thesis. But we should see that. If we start seeing signs that the Fed won't ease up, or signs that the ECB will, right, and that might change the DXY's trajectory, then we need to beware of that. But for now, I'm very bullish on gold and silver in the first half of 2023. I'm also very bullish on, just go ahead and branch out. I'm the other yellow metal. Sometimes I'm not sure which one deserves that moniker. Gold was up a fraction of a percent by the time trading closed on December 30th, 2022, whereas uranium ended up the year about 12% up, and it remains in a very nice 5-year upward trend. From $18 to $48 is a pretty nice rally, better than gold. And I think that's very, very strong. I mean, I could go on at length about this, and so I won't, but I just, quickly, this seems like very much an idea whose time has come. We have a new nuclear renaissance picking up steam in a big way. The war has been a huge wake-up call in Europe. Eastern Europe is clearly piling in that direction quickly, and Western Europe, even the Germans, who, they said hell would freeze over before they would keep those nuclear power plants. And it seems like it only took a bit of Germany to freeze over before they changed their mind. But reality matters here. And, for better or for worse, I am persuaded by the macro theory that there is absolutely no way for the green agenda to be achieved without nuclear power. And I think the powers that be get that. And I don't think they're going to give up on the green agenda. Therefore, absent, I'm not sure even a Fukushima type event would do it, because, it wasn't really a nuclear incident. It was a tsunami. So absent a Chernobyl type event, I think this is extremely solid. And by the way, it's happening now. Like, I don't know what's going to happen with the DXY. I think it will continue this way for the next couple of quarters, but it could reverse. Whereas uranium, you've had the Sprott Trust hoover up all the cheap pounds. You've had the Japanese restarting or ramping up and going more pro-nuclear now. So all that secondary supply is gone. And you've got utilities starting to sit down with the miners to sign long-term contracts. And you've got the US just... Pardon?
The UK just announced a big spending package for their nuclear fleet.
They've been talking about it for a while, but yes. But the US has come to the table as a buyer. That's been all this fuss about the US national uranium reserves, like the Strategic Petroleum Reserve or political reserve, as it turned out to be. But they're building a uranium stockpile, and that has added the US now as a significant new buyer that wasn't there in the market. Like, there's all these things, Tom, that make this a really, really strong trend. And the mine supply, even though it has been under voluntary constraint like OPEC, even without that constraint, it's not sufficient without the secondary supply, which is now being removed from the market. So I'm extremely bullish on this immediately. And it's been straggling for the last half of 2022, but that's just so much the better for anybody new to this story. I may be wrong, but I am betting heavily on uranium. It has taken on a much larger portion of my portfolio than I expected, because I'm very, very bullish on that. And almost everything else, I would wait to see how the recession shapes up. Even copper, my favorite industrial metal, I'm not buying any copper plays right now, not until the recession hits. And, I think I might be able to get, some of the best copper stocks in the world at 30, 50% off easily, with no bad news from the companies, just based on that. Oil is also, I think actually ESG drives are going to send oil prices through the roof. People are strangling, governments, institutions, investors are strangling that industry of capital, and it will be underinvested. We're cutting off the oil supply before we have the replacement ready, and that means higher oil prices. But that doesn't mean that oil won't go down immediately as the recession, in the immediate near term, as the recession really puts a scare into the marketplace. So pretty much everything else besides gold, silver, and uranium, it's let's see how the recession does.
Yeah, I think, to that point on the oil demand side, that recession drop in demand materially matters to that market. Whether it's an elastic commodity or not, it is going to matter to see how much oil the world really needs as the recession takes hold, right?
Right. And again, countervailing forces, you've got China reopening, you've got the new Iron Curtain putting inefficiencies in that market. We'll see. I'm not saying I know that oil will go down in the near term. I'm saying that there is enough of a risk there that I'm not willing to take on more exposure to oil and gas until I do know.
Absolutely. Logo, is there anything else that you'd like to touch on before we wrap up today's conversation?
It's been a lot more philosophical than I thought. So we covered my major theses on the metals and mining. Just one final thought would be to my dear fellow gold bugs out there. I know how frustrated many of them were with 2022 not going the way we hoped it would. People are disappointed that gold didn't perform better in an environment of high inflation. But remember, we had the dollar rallying quite strongly through most of the year. We had real interest rates going from extremely negative territory to much less negative territory. Both of those in the modern world we live in would normally have been huge headwinds for gold. So I actually think gold traveling sideways in that circumstance was a big beat. And you're not wrong. Money printing does matter. Inflation does matter. I think that base effects will bring measured CPI and PCE down, but I think they will be stickier at higher levels than the mainstream imagines. And I do think that that will be supportive, whatever the wrong trousers do, I do think that will be supportive for gold and silver going forward. So that would be the other thing is, watch the inflation rate, not just the DXY. Let's see if it comes down as fast as the mainstream thinks it will. And if not, I think that'll be another rude awakening that could really change the markets in our favor.
Mm-hmm. Well, plenty to pay attention to, and hopefully we can have you back soon to have an update on how you see any of these ideas changing or developing, Lobo. Of course, all of the articles that we talked about are available at independentspeculator.com. And if you want to follow Lobo on Twitter, it's also Due Diligence Guy, right?
Yes.
Perfect. Thanks so much for your time today, Lobo.
Pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.